Big Target shakeup. CEO steps down, insider named, sales slip, stock tumbles. Listen up. In the next 20 seconds, you'll get the 5 facts that matter and why they change everything for shoppers and investors. Quarterly sales were about $25 billion. Earnings were roughly $2 a share. Same-store sales fell about 2%. The stock dropped roughly 8% on the news. New CEO takes over February 1, 2026. Okay, here's what happened and why you should care. The longtime CEO announced he will step back, and the company promoted its chief operating officer to CEO. The handoff is scheduled for February 1, 2026. The outgoing CEO will move to an executive chair role. That means leadership continuity instead of an outsider coming in to shake things up. Numbers first, plain and simple. Revenue for the quarter came in at about $25 billion, and earnings were about $2 per share. Those results technically beat very low expectations, but the beat was built on heavy discounts and clearance moves, not on strong retail fundamentals. The raw totals look okay, the underlying trends do not. The clearest red flag is same-store sales, down about 2% year over year. That's the best single signal for what real customers are doing in stores, less traffic or smaller baskets. Online growth offsets some pain, but not nearly enough to steady the ship. If stores weaken, profits follow. Investors reacted fast. The stock fell roughly 8% after the results and the leadership news. Traders said they wanted an outside CEO to reset strategy quickly. Picking an insider signaled continuity, and continuity scared short-term investors who wanted faster change. Expect volatility. Why this matters for everyday shoppers. More markdowns and clearance events are likely as the company works through excess inventory. You'll find deals on clothing, home goods, and seasonal items. But store experiences will be hit or miss while they fix assortments and restocking. If you value consistent, full shelves and neat displays, be patient. If you want bargains, this is a shopping moment. Why this matters for investors. This is an execution story, not a brand story. The company still has scale and a strong name. That's valuable. But the market now prices in uncertainty for the next 12 to 18 months. The path back to steady profits depends on clearer product mixes, fewer markdowns, and faster inventory flow. Those are operational fixes that take time. What went wrong this quarter? Short list. Wrong product mix for current shoppers, inventory and supply issues causing empty shelves or the wrong items in some stores, heavy promotions to move stock that hurt gross margins, cost pressure from tariffs and imports that squeezed margins further. Put together, those problems explain why a beat still felt weak at the surface. Discounts can hide demand problems for a quarter, they don't fix them. What the board did and why investors didn't like it. Investors hoped for an outsider to come in and reorder priorities. Instead, the board picked a longtime insider. An insider means the company is betting on continuity and internal fixes. That can work if execution improves fast. If it doesn't, investors will push harder for change. The stock drop is the market's way of saying prove it. What management says it will do next. The public plan is operational. Tighten assortments, simplify buying, and invest in tech to speed inventory flow, and try to keep prices steady when possible. That is steady and cautious. Don't expect overnight miracles. How this will play out in real stores. Expect local clearance cycles and targeted promotions to clear slow-moving items. Some stores will improve faster than others. The goal is clearer product selection, fewer emergency discounts, and a smoother checkout experience. Those are the visible signs shoppers will notice first. Metrics you should watch next, the 5 checkpoints. The new CEO's first 90-day plan and any key hires or reassignments. Concrete moves matter. Next quarter, same-store sales. If comps stop falling, that's the first real green flag. Gross margin trend. Fewer markdowns and better margin percentage prove progress. Inventory days and in-store execution. Cleaner shelves equal fewer surprise promos. Outside hires in merchandising or digital, bringing fresh talent signals real change. If a few of those checkboxes turn green in the next 2 quarters, the market will calm. If not, the stock stays under pressure. Scenario time, 2 short paths. Good path, the company tightens assortments, reduces forced discounts, and speeds replenishment. Private label brands and better seasonal buys lift margins, stores look consistently better, traffic returns. The stock recovers over time. Bad path. Change comes slowly, markdowns continue, and customers permanently shift more spend to cheaper competitors. Margins erode further. That forces deeper cuts or a more radical leadership move later. The stock stays weak. A quick note on valuation language you might hear. Instead of P over E ratio, think the stock price is X times the company's earnings. Instead of market cap, say the company's total value. Those phrases tell the same story in plain terms investors actually use. Use them when you want to compare how pricey a stock looks versus its profit. Tactical moves I expect to see fast. Reassign buying teams to focus on top categories, push private label launches that have higher profit per unit, run local promotions to clear inventory without wrecking national price perception, ramp up basic store execution, better displays, staffing at peak times, and faster checkout. These will be the early tests for the new leader. How to act if you're a shopper. If you want deals, check clearance and digital offers. If you want consistency, wait a quarter or two for the operational reset to show. Don't assume every store is fixed immediately. How to act if you're an investor. Set data-driven checkpoints. Watch comps, margins, and inventory flow. If you trade the news, expect volatility. If you invest for the long term, ask whether the company can show consistent margin recovery and clearer assortments. That's the real driver of value here. Timing and expectations. Expect visible operational improvements, if they come, over 2 to 4 quarters. The first 90 days are about signals, hires, memos, and small restructures. Next quarter is where measurable comps and margin directions start to show. Bigger brand shifts take longer. Bottom line, this quarter was a mixed message. The headline numbers looked okay because of discounts and low expectations. The underlying trends show customer pullback in stores and margin pressure. The insider CEO pick means continuity. The market wanted change and punished the stock for not getting it. Now the burden is on the new leader to deliver visible, measurable fixes. If they do, the recovery is possible. If not, the company faces a longer, messier fight for share. Thanks for sticking with me. If this cleared things up, hit like. If you want straight market updates, subscribe. Hit the bell so you don't miss the next check-in when we track the new CVO's first moves and the next quarter's results. See you next time.